Welcome to the deep dive. Today, we're really opening the hood on something pretty critical, but maybe not always visible in the Canadian economy: captive finance. Yeah, we're talking about those specialized lending arms, the ones attached to the big auto manufacturers. The company is actually behind those car loans and those really tempting lease deals you see everywhere. And our mission today, it's simple, really. We want to give you a kind of shortcut, help you understand how these huge global forces think inflation, trade wars, central bank decisions, how they get baked right into the numbers on your Canadian car payment, whether it's a loan or a lease. We're going right into the strategic thinking, the source material that guides their, well, frankly, multi-million dollar decisions.
And it's clear from that material, this isn't just straightforward retail lending. Not at all. What's really fascinating, I think, is the sheer level of complex, constant macro forecasting they have to do. They're not just, stamping approved on credit apps. They're managing billions in future assets. The whole operation pivots on having funds ready for when people want cars. That's what they track as liquidity risk. If that forecast is off, the whole pipeline could just dry up. It's serious stuff.
Okay, right. So let's unpack those inputs then. If you peek behind the curtain, these companies are watching what, 5 key economic signals? Like every single day, we can probably group them maybe: domestic health and global vulnerability. So domestically, number one has to be inflation, right? The consumer price index, CPI, that seems like the starting point for almost everything. It hits the cost of the car itself, obviously, but also, crucially, how much money consumers actually have left for that payment, their purchasing power.
Exactly. And tied right into that, number two, the Bank of Canada policy rate. This is like the central nervous system for their funding costs.
Yeah.
It drives the prime rate and ultimately how they price the final loan or lease. If the BPOFC makes a move, believe me, they react instantly.
Absolutely. Okay, so the third and fourth domestic ones sound like they're all about risk. You've got GDP growth. That signals what? The overall strength of demand, tells them if sales volumes might hit their targets.
Yeah, precisely. And then unemployment. That's the tough one. It's directly tied to their credit risk. It feeds straight into their loss modeling. If unemployment spikes up, their models have to immediately account for, well, more defaults down the line.
Right. And the fifth one pulls us onto the world stage.
Definitely. Tariffs, trade tensions, geopolitical risks. And look, this isn't just abstract theory. We've seen it happen. Tariffs can completely change the cost structure of vehicles, mess with the supply chain for essential parts, and create huge uncertainty around residual values, what the car will be worth later.
Okay, so they have these indicators. How do they translate that data dump into actual financial strategy? You mentioned some core theories they lean on.
Yeah, they really do. Two come up constantly in their planning documents. First is the Fisher effect.
Right, the Fisher effect. For listeners, that's basically the formula saying the nominal interest rate we see is roughly the real interest rate plus what everyone expects inflation to be.
Correct. And for
Yeah.
them, it's like their crystal ball for figuring out funding costs down the road. They use it to try and predict future nominal rates based on where they think inflation is heading. That prediction directly tells them how high they need to set today's loan and lease rates to protect their margins.
But that sounds like it hinges entirely on them guessing future inflation correctly. I mean, given how volatile things have been, how often do those models even get updated?
Oh, constantly. That's the huge challenge, right? If they underestimate inflation, maybe lock in too low a rate now, they could find themselves holding loans that become unprofitable when their own funding costs jump a year later. It forces really defensive pricing. That's partly why we saw rates climb so quickly.
Okay, that makes sense. And the second theory?
Purchasing power parity, or PPP. The basic idea behind PPP is that exchange rates should adjust over time so that, say, the same basket of goods costs roughly the same in different countries. For a Canadian captive finance company, this is huge. If the Canadian dollar weakens significantly against, say, the US dollar, well, the cost to import the cars themselves, the capitalized cost, it just jumps up instantly.
Okay. So if the Canadian dollar drops, the sticker price of the imported car effectively goes up here in Canada, which makes the lease payments higher for the consumer or maybe riskier for the captive because they're financing a more expensive asset that might not hold that extra value within Canada.
Exactly that. It's an immediate risk transfer, straight onto the books.
Okay, that leads us perfectly into the real mechanics then, pricing. Moving from these big macro ideas, how do they actually calculate the rate you see on the showroom floor? For a standard loan, the basic formula looks pretty straightforward on paper, right? Your rate is to their cost of funds plus their operating costs, plus a credit risk premium, plus their profit margin. Simple enough.
Well, simple in structure,
Yeah.
maybe. But remember, every single piece of that formula is being pushed and pulled by those 5 macro factors we just talked about. It's constantly shifting.
Right. And leasing, you said, gets even trickier.
Oh, yeah, definitely more moving parts. The key variables are the capitalized cost, that's the vehicle price, the length of the lease term, the residual value forecast, and the money factor.
The money factor.
Yeah.
That's an interest rate for the lease, essentially.
Sort of. It's the borrowing cost applied specifically to the depreciation part of the vehicle during the lease term. Just as a quick guide for folks, you can multiply the money factor by 2,400 to get something close to the equivalent annual percentage rate, the APR. Helps you compare the borrowing cost.
Gotcha. Now, I think a really crucial term here, especially for consumers trying to understand deals, is subvention support. What exactly is that, and why would the manufacturer do it?
Subvention. That's the manufacturer's, let's call it, secret weapon. Or maybe not so secret. It's when the OEM, the original equipment manufacturer, the car brand itself, decides to basically subsidize or buy down the interest rate to help move cars. So let's say the captive finance arm calculates that based on their costs and risks. They need a 6% APR to make a profit on a lease. But, the competition is offering 3.9%, and they need to match that to get sales. The OEM might step in and essentially pay that 2.1% difference to the captive.
So the OEM is taking a hit on its profit margin from the actual sale of the car, just to allow the finance arm to offer a competitive rate that gets people signing deals and moves inventory off the lot. It's really a volume tool, not a reflection of the true financing costs.
Precisely. It's this constant balancing act for them, maximizing immediate sales versus maximizing overall profit margin per vehicle. It shifts all the time based on inventory levels and market conditions.
Okay, let's spend a bit more time on residual value. You mentioned it, and it sounds like that's where some of the biggest financial risks are, especially in leasing. So it's the predicted wholesale value of the car when the lease ends, maybe 3 or 4 years down the line. Why is getting that number right so hard and so risky?
Because it's essentially a huge financial bet on the future.
Yeah.
You're making assumptions about market conditions years from now. Now, if the captive sets the residual value too low, the monthly payment calculated will be too high. Potential customers walk away, go to a competitor. That's bad. But the major pitfall, the one that keeps finance managers up at night, is overestimating that residual value. Imagine they predict a car will be worth, say, $30,000 when the lease ends in 3 years. They base the monthly payment on that assumption. But then, maybe the used car market tanks, or a much better new model comes out, making the old one less desirable. And the car is actually only worth $25,000 wholesale. The captive just absorbed a $5,000 loss on that one vehicle when it comes back. Multiply that across thousands of leases. Well, you can see how it becomes a massive portfolio loss they have to cover.
Wow. And I guess the speed of tech change, especially with electric vehicles, must make this forecasting almost, well, nightmare fuel. You're not just predicting standard depreciation, you're trying to guess the obsolescence rate of today's battery tech compared to what might be available in 3 years.
That's spot on. It's a massive headache.
Yeah.
The pace of innovation in battery range, charging speeds, even software features. It means an EV that seems cutting edge today could see its value drop much faster than a traditional combustion engine car. So yeah, they need incredibly sophisticated models just to calculate the break-even residual value, the minimum future value needed to avoid losing money on the lease portfolio. It's complex.
Okay, that flows perfectly into actually managing all this risk. You can't juggle billions in assets without some pretty robust safety nets. The source material seems to point to 4 main types of risk they're constantly dealing with. How do they define those, and maybe how do they interact? We've touched on interest rate risk, right? That pressure on margins when the BSE hikes rates. And residual value risk, getting that future prediction wrong. What else?
Then there's credit risk. That's the straightforward risk of borrowers defaulting on their loans or leases. And it's very closely linked to things like unemployment rates. And interestingly, these risks can sometimes push against each other. For instance, if the Bank of Canada raises rates really aggressively to fight inflation, that definitely increases their interest rate risk, their funding costs go up. But that high rate environment often cools down demand for new cars, which can sometimes, temporarily at least, prop up used car prices. So ironically, aggressive rate hikes might slightly mitigate residual value risk in the very short term, even as they amplify interest rate risk.
Interesting tension there.
Yeah, but conversely, if the economy suddenly tanks, defaults could spike hitting them with credit risk, and at the same time, a flood of repossessed or off-lease cars could hit the used market, pushing residual values down sharply. So then those risks compound each other.
Okay, and the fourth risk.
That's operational risk. This covers everything internal. The risk that their complex forecasting models have flaws, their IT systems fail, or even just human error in their processes leads to unexpected financial losses or exposure.
So how do they fight back? What are the tools they use to control these exposures?
They have a pretty sophisticated toolkit. A key defense against interest rate risk is using hedge accounting. This involves financial instruments, most commonly things like interest rate swaps. Effectively, they allow the captive to lock in a fixed borrowing rate for a certain period, regardless of what the central bank does.
Ah, okay. So even if the Bank of Canada delivers a surprise hike, say 100 basis points, the captive's actual cost of funds might stay stable for a while because they already agreed on a fixed rate with their own lender through that swap agreement.
Exactly. It provides crucial stability for their planning and pricing.
Makes sense. And for credit risk, beyond just saying no to applicants.
Well, they rely heavily on dynamic credit scoring models and something called risk-based pricing. It means applicants who are deemed higher risk based on the models are either declined outright or, more commonly, they're charged a higher interest rate, that extra percentage point or two. That's the credit risk premium we saw in the pricing formula earlier. It's specifically designed to build a buffer to offset the higher expected losses from that riskier segment of borrowers.
Right. And something that seems really important now is IFRS 9 provisions for expected credit losses, or ECL modeling. That sounds technical, but what does it actually mean for how they manage risk day to day?
Well, IFRS 9 was a huge shift, a fundamental change in accounting for risk. It basically forces these companies to look forward, proactively, instead of just reacting. Before IFRS 9, companies typically only set aside money for loan losses after a borrower had actually missed payments or defaulted. Now, under IFRS 9, they must look at those macro forecasts we talked about, rising unemployment predictions, GDP slowdown warnings, and estimate the potential future losses across their entire loan book before those losses even happen.
Wow, okay. So they can't just wait for the recession to officially start. They have to adjust their financial statements today based on the probability or expectation of a future downturn.
That's it, exactly. It forces them to hold more capital aside as a buffer against those potential future losses. It makes the whole system more resilient, theoretically, but it also means their financial results become much more sensitive to negative economic news and forecasts. Bad macro outlook. They have to book higher provisions immediately.
Okay, let's try to tie all these threads together. Section 4, applying this to a real-world type scenario. The source documents often use these convergence examples, right, where multiple risks hit at once. So let's imagine a scenario. US-China trade tensions suddenly flare up again really badly. Tariffs get slapped on key components, maybe EV batteries specifically. And at the same time, let's say the Bank of Canada is forced to raise its policy rate aggressively, maybe 150 basis points over a short period to combat stubborn domestic inflation. A double whammy.
Right. That's a really tough scenario. And the impact on the captive finance operation would be immediate, and it would hit them from multiple angles simultaneously. Both the balance sheet and the income statement get squeezed. So on the supply side, those tariffs on batteries mean the cost to build the EV goes up. The MSRP, the sticker price, spikes almost instantly. That directly increases the capitalized cost for every single lease they write on that model.
Okay, so the asset itself becomes more expensive. What about the funding side?
Well, that bossy rate hike means the captive's own cost of funds goes up sharply too. So now they have to pay more to borrow the money needed to finance that more expensive vehicle. You see the bind. The cost of the asset is up and the cost to finance it is up. Affordability just plummets for the consumer. The almost certain result is a significant drop in sales volume for the manufacturer, the OEM.
So the car company is stuck with expensive inventory that people suddenly find much harder to afford financing for.
Exactly. And faced with that situation, often the only lever the OEM can pull to try and move those cars is to massively increase that subvention support we talked about earlier. The manufacturer basically has to eat a much larger portion of the monthly payment cost just to make the deal look halfway attractive to consumers. And meanwhile, back at the captive finance company under IFRS 9 with rates rising and demand slowing, they're almost certainly going to have to increase their provisions for expected credit losses because those conditions often signal higher unemployment and more defaults are coming. It really is a perfect storm scenario. Sales volume drops, funding costs soar, credit loss provisions go up, and the OEM's profits get hammered by having to pay out huge amounts in subvention.
Wow, okay. So bringing this home for you, the listener, trying to navigate the Canadian car market, What's the big takeaway? I guess the key lesson really is you have to connect the dots. Always try to link those big macro events you hear about, inflation numbers, Bank of Canada announcements, global trade disputes, directly to the real financial implications for businesses. Think about how it impacts their funding costs, their potential sales volume, their profit margins. It all connects.
Absolutely. And that really leads to our final point, which is a call for, well, critical thinking. When you're looking at rates, whether it's for a car or any big purchase, try not to just accept the number. Think about the why. Understand the risk pricing that's built into it. Stay curious, read those Bank of Canada summaries, look at the StatCan data releases, but see them through this lens. How does this impact business costs and risks? If you see unemployment ticking up, you can be pretty sure that the credit risk premium baked into loan rates is also going up. It's all linked. And maybe here's a final thought to leave you with, something provocative perhaps. It builds on that idea of the discount rate. When the captive calculates your monthly payment, they're using a rate built from the risk-free rate plus various risk premiums, right, driven by all those macro inputs. Well, that exact same fundamental principle, time value of money, adjusting for risk, is what they use for the much bigger task, the fair value measurement and the overall valuation of their entire massive portfolio of loans and leases. Billions of dollars.
So every single assumption they make about future inflation, about credit defaults years from now, about what those cars will be worth at lease into every single one of those forecasts directly influences how they value potentially millions, even billions, in assets on their books today. It really underscores how much the entire health and valuation of the company hinges on getting those forward-looking predictions as right as possible. It all comes down to the forecast.